In this week's market update, 2019's strong start is threatened by rising trade tensions, more mixed messages from central banks, and Brexit is back in focus after the main party's local election drubbing. Stock markets around the world have wobbled this week after Donald Trump ratcheted up pressure on China with a renewed threat to increase tariffs. Chinese shares bore the brunt of investor nerves, down by as much as 6% on Monday before recovering marginally on Tuesday and then falling again last night to a two-month low. Investors are quite reasonably asking whether deepening trade tensions might mark the end of a remarkable 4-month rally for global equity markets. It's been the fourth best start to the year since 1970 for the MSCI World Index, and the fear is that at least one of two main supports for shares, a resolution of the ongoing trade dispute, has been kicked away by the US president. Since the start of the year, the S&P 500 index has risen more than 10%, while Chinese shares have risen by more than twice as much. Other markets around the world have also delivered double-digit gains in just 4 months, as investors have put 2018's fourth quarter trade and interest rate fears behind them. Now the concern is that on both fronts, the good news is running out. The S&P 500 fell on Tuesday by 2.4% at one point before recovering to end 1.7% lower. On trade, no one is quite sure whether the latest outburst from the White House is real frustration with China or just another negotiating ploy. US officials denied they were just playing games, prompting Tuesday's slide. Either way, it casts doubt on the bullish narrative that says a trade deal is inevitable because it's in both countries' interests. Investors are not taking any chances. As equities fell, they sought out the relative safety of government bonds, and the Japanese yen rose against most other currencies, hitting a 5-week high of 110 to the dollar. Meanwhile, on interest rates, stronger than expected jobs figures on Friday after bullish comments from the Federal Reserve after last week's rate-setting meeting suggests that market hopes for a rate cut before the end of the year may be over-optimistic. The outcome of trade talks is key to both the outlook for the global economy and for stock markets, with growth slowly improving in Europe and evidence that Chinese stimulus is starting to have a positive impact. An agreement between the US and China could see a return to synchronized global growth and another leg up for shares. The danger is that Mr. Trump overplays his hand. China is reported to be fuming about his latest threat and the accusation that Chinese negotiators have gone back on commitments made in earlier rounds of talks. With markets back up to all-time highs, investors have less tolerance for negative news flow than they did last Christmas after the fourth quarter market slide. The second key driver of markets at the moment is central bank policy. Here too, messages are mixed and hard to read. Jay Powell, the Fed chair, is finding it particularly difficult to gauge the market mood. Having suggested that low inflation was a big challenge for central banks, he seemed to change tack last week by arguing that weak prices were just transitory. Investors who'd been hoping for a so-called insurance interest rate cut this summer scrambled to revise their expectations. The bullish take on the US economic outlook was confirmed on Friday when it was announced that 263,000 new jobs were created in April. That was more than expected, and the robustness of the American jobs market was confirmed by a fall to 3.6% in the unemployment rate. On this side of the pond too, the Bank of England is struggling to manage expectations. Governor Mark Carney is expressing the likelihood of higher rates in ever more forceful terms, but the markets remain sceptical. Although interest rates are close to their all-time low at just 0.75%, financial futures are pointing to just 1 quarter-point hike in the next 3 years. The political backdrop continues to argue for caution, with the Brexit impasse as intractable as ever. Although talks resume this week between the government and opposition, neither side is negotiating from a position of strength after last week's local government elections saw the two main parties handed a drubbing by disgruntled voters. The government lost more than 1,300 council seats in its worst performance since the final days of the John Major government in 1995, when a series of sleaze scandals had made the long-in-the-tooth Conservative government a lame duck administration. In 1997, Tony Blair swept to power in a landslide that was foreshadowed by a strong performance in the 1995 local elections. Well, any hope that Labour might benefit in the same way this year were confounded, however, by a dismal performance from the opposition party, which has failed to capitalise on the government's problems. The big winners were the pro-Europe Liberal Democrats, which gained more than 700 seats, and the Greens, which added 200 to their previous tally. The vote sets up an acrimonious European Parliament election in a couple of weeks' time, at which an openly pro-Brexit party led by Nigel Farage is expected to win over many voters from both the Conservative and Labour camps. Now, for followers of Warren Buffett, the weekend saw the annual Jamboree in Omaha, Nebraska, where the world's most successful investor has lived throughout his remarkable leadership of Berkshire Hathaway, the investment company he founded in 1965. The annual meeting has become a staple of the investment calendar, dubbed Woodstock for capitalists, as thousands of Buffett's followers travel to the Midwest to hear their hero speak. This year's event was somewhat overshadowed by negative stories about Berkshire's performance over the past decade, in which the company has underperformed the S&P 500 overall. It's worth putting the 10-year numbers in context, however. Since 1965, Berkshire Hathaway shares have risen by 20.5% a year in aggregate. That compares with 9.7% for the US market as a whole, and has resulted in an overall gain of about 2.5 million% versus just 15,000% for the S&P 500. It's a remarkable performance that will almost certainly never be matched. Even the mighty Buffett is not invincible, however. When you have a track record as good as his, you can afford to admit your mistakes. And this year he put his hand up and said that he'd been buying into Amazon for the first time. "I've been a fan and I've been an idiot for not buying," he said. It's just the latest example of a change of heart by Buffett about the technology sector, which he has long claimed is outside his sphere of competence. 3 years ago, he bought into Apple, and the iPhone maker is now Berkshire's largest single holding, worth $40 billion out of the company's $173 billion equity portfolio at the end of last year. And looking forward to the rest of this week, the earnings focus shifts across the Atlantic from the US to Britain, with only around 60 of the S&P 500 index constituents due to report results. Names include AIG, TripAdvisor and Disney. Also in focus is recently floated Lyft, which last night showed why investors have turned negative on the company since its IPO. A $1.1 billion quarterly loss and the promise of slowing revenue growth to come saw the shares fall further below their $72 flotation price to just $57. Over here, companies in the spotlight include Imperial Brands, ITV, BT, Barrett and Morrisons. On the economic data front, the highlights are Friday's UK GDP number and US inflation data on the same day.